Session is being recorded. Good evening, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 9:17 p.m. on a very chilly evening here on the waterfront on the Jersey City side across from New York City. It's approximately 21st of October 2018. This session will be recorded, uploaded to the Google YouTube Clueless A Trading channel. Feel free to review it at any given time. It's available to anyone out there who has internet access. Very valuable resource of information. Full disclosure, this is purely for financial education, not for solicitation or advice. Just a quick reminder and a plug for our Instagram, brand new Instagram channel, which is picking up followers right, left, and center. We are going to be approaching 400 followers soon, and once we hit 500, obviously the algorithms on Facebook are going to pick it up and spread it around. So feel free to spread the word and take a look at it. It's interesting. It's entertaining. It's primarily for promotional purposes and not for real-time content that is being delivered on the real-time Twitter feed, as you guys all know. Thank you for attending. We have a great crowd. Raja, thanks for being here tonight. We have Mike, my good friend. And we have Serge, brand new member. And we have Sarm, who is also a recent member and a terrific individual. I've spoken to him a few times. So on that note, let us begin. I'm just going to basically try to skip through charts tonight. A couple of broader things on the market that I need to let you guys know about, which you guys obviously already know. Nothing really happened over the weekend, as in economic fallouts and things like that, aside from the fact that the outflows of money from the Chinese markets are probably reaching a peak right now, as the Chinese currency is hit hard. The Chinese renminbi and the yuan, it gets hit hard. Obviously, foreign investors, just in a mechanical form, tend to take money out of the Chinese markets, technical reasons, margin sells, you name it, and that causes an outflow. That caused the Chinese market to drop very heavy on Thursday night, and on Friday, their trading day, the Chinese market actually rallied very hard, despite the fact that we basically came down after midday, after opening up higher. As you all know, the Chinese markets actually ramped up. Chinese markets are opening right now approximately around 9 p.m. There has been a lot of support coming out of the Chinese government as in supporting their markets. Some very strong comments from the Pboc, which is the People's Bank of China, their Federal Reserve, and from other government officials that they are going to do whatever it takes to prop up the Chinese private markets. They do not want to see foreign investors fleeing the Chinese markets, especially with great companies that are in China, Alibaba and all those companies included, just because their currencies are getting clobbered. This is a trade war at full bloom. I will be the first one to say it, even though the tariffs have not all gone into effect. The fact is, it is no longer a trade skirmish. We are in the middle of the first stage of a trade war. And that's the reason why the markets are so volatile. That's the nature of the beast. In between that, traders can make money, as we have shown repeatedly, and losses are sustained if traders do not act quick. There is no easy answer to this. We do not control the global economy or government policies that drive global economies. And at this point, we have to basically resign ourselves to the fact and accept the fact that the trade war is not going to, it looks like at this point, and anything can change. And in my half a century of being on this earth, I have realized one thing: when the butterfly thinks it's the end of, when the caterpillar thinks it's the end of the world, the butterfly knows it's just the beginning. It is not just a tantric, yoga type of saying. It is a fact. When we all think it's all over, it just begins again. That has always been the nature of every crisis since, go back to the most recent big crisis, which was 1987. October 19th, 1987. I was certainly not there at that time. I was at college, my undergrad studies. But that's just the way it is. Behavioral finance comes into play in a big way, as we all know. Humans tend to get extremely bearish and bullish at the wrong points. We know that. And we all suffer from that. There's no question about it. Because our focus in what is our focus remains as humans, what is happening directly in front of us, not what will come in front. We are always looking to see what is happening now, whether we like to realize it or not, whether it's in trading or in life. We don't take into consideration what will happen after. And that is the difficulty of financial forecasting and human behavior. We know that. Traders are always recency biased. They're always dealing with what is happening in front of them. So that's for that reason, we try to basically put our 2 cents across at Clueless Ape Trading and show tactical charts across the board and show the probabilities of what might happen, what up and down, and so we're prepared for it. It is never easy, but certainly overall, it has certainly been a profitable venture since I started my service in 2014, April 15th on tax day. So on that note, we have very smart traders in our group who use my charts to and their own skill sets, as I've said in my previous video, to do what they need to do, short the market. You know, they have their own biases about what's going on, and they can do whatever they need to do. And that is that's the nature of the beast. We are not at Clueless Ape Trading. We are not running your trading books. You are running your own trading books. We are providing very tactical charts and some suggestive alerts, which overall have been very profitable, and in some cases not profitable, losses. So the bottom line is you have to use your own decision to do what you need to do. Okay. On that note, the broader picture again, the China Pboc and the Chinese government has basically issued very strong statements defending their markets. They do not want their markets to completely collapse and create another financial crisis in China. China has many issues, not just trade issues. We have many issues, not just trade issues, but China has many issues which have, one of the issues that they have, which we don't have, is called shadow banking. Shadow banking is the underground banking away from the official channels. Our banking is primarily in official channels, and we have a very, very small shadow banking, which is behind the scenes type of lending that goes on. In New York, we have a lot of shadow banking. We have the mafia. I'm just kidding. I'm not kidding. So the bottom line is, and we have the Russian mob, okay, which also does a lot of lending. So the bottom line is that, but overall in the national economy, our shadow banking risk is very, very contained. China, unfortunately, still has not done a great job because it's a very difficult job. It's like extracting a bullet out of your, whatever, limbs, right, of your arm, because you accidentally got shot, whatever, and it's very painful. And China has been delaying that for a while, but they're forced to do that, and that causes big disruption to their economy. So aside from that, the Saudi situation with them just chopping up, I hate saying that, but that's what they did to their one of their own citizens, a U.S. resident, but working for the Washington Post. But very terrible tragedy. But at the same time, I don't get into messing with the politics of other countries, and that has somewhat of an impact on the markets, just so you all know, primarily because Saudi government and the Saudi sovereign fund owns a lot of U.S. stocks. Prince Al-Walid bin Talal is one of the largest investors of Citigroup, Google, Twitter, you name it, right? So if they start to liquidate, which I'm sure they have been liquidating part of their holdings, some of their holdings, because of this fiasco that they created, then it will have an effect on our market. The second thing that's affecting the markets in a big way is global margin calls that are coming out of Chinese sovereign funds. Okay, and that is causing a lot of companies to act. Like they said, those big sell-offs that we get right after we say, okay, buy, futures open up 15, and boom, the sell-off comes around 11, 12 noon. They come through on the Asian markets, then we pop up, and then the European markets basically execute a bunch of their sales. Because remember, global sovereign funds and global funds, whether they be sovereign, i.e. owned by the countries themselves, or hedge funds, execute their trades in global markets. So a lot of the trades are done through European large banks. So they hit our markets in the morning, right? So you guys know that. So if you didn't know, now you know. So that's why we have the volatility. Our funds in general know our companies the best. U.S. companies are doing rather well. Of course, they're being affected by this ongoing trade skirmish. Some of the companies have started to talk about the effects of the tariffs. But at the same time, you look at the Procter and Gambles of the world, which sell everything from toothpaste to your, whatever, every household good, said that the global business is strong, even in China. So what do you say? Procter and Gamble rallies like crazy. Individual companies will do what they need to do. So let me get back to the broader theme here. So as I'm doing this, I'm just flipping the chart so you don't get bored looking at the same picture. So the bottom line is that at this point, we are in the thick of the earnings season. We have a very big earnings week coming up this week. We have Alphabet, Google, the biggest marquee names on the block. I have we're going to go through very quickly some of the earnings that we're going to play this week, right? This is starting October 22nd. Lots of earnings. Look at that. I suggest some of them. I cannot suggest all of them. It's like, I know that Thursday after the close, the big ones are coming out. There's a lot of companies when we buy the basket of earnings, which overall, our last earnings season was a unmitigated winner. Overall, the baskets that I produce, I've back tested all of them. We have had a couple of losses in the basket, big wins. Overall, net, the baskets in general performed 7 out of the 10 baskets of earnings every single day during earnings season. Last quarter was on the positive. Remember, you buy 5 companies, 6 companies, you buy 1 contract each. I don't care how many contracts you buy. I suggest that you don't put in too much money. Let's say you want to put $1,000, $2,000 towards the earnings play every night, or $500 or $1,000, or even $500 or $300. I don't know. Bottom line is that if you buy the basket, you have a better shot of being positive. Small accounts can grow very quickly. I've said this before. I'll say it again. Very quickly if they play the earnings baskets. Because a couple of them will give you 3, 4, 500%. Look at PayPal on Friday. Okay? Look at Honeywell. Look at American Express at the open. And then we had the losses on VFC. And what was the other one? I forgot. And so bottom line is that net, it was great. So lots of earnings coming out, and people are always scared about earnings because they're stuck with their old baggage. I don't blame them. Which reminds me to a very important point that I want to make. Going forward, keep in mind, futures are starting to bump up nicely right now. Going forward, futures are down about 8. They were down about 17 when we started this session. Going forward, I want to remind everyone one very important thing here. You're running your own books. Do what you need to do. I will keep on suggesting what I think is what will make money. Some will make money, some won't. Overall, they'll make money. Why? Because that's what I've been doing since I started my service in April of 2015. Net, it's been a huge winning curve for clue-to-say trading overall. But so I just want to remind everyone, you are in charge of your own destiny. Take my suggestions, use your own skill sets, short, go long, do whatever you need to do. And I am not here to question your decisions, and you do what you need to do. When it comes to earnings and stuff, it is always a 50-50 gamble. Some of the companies I know very well, and a lot of my technical work is based on the fundamentals that I already know about the companies, and earnings is about gut feelings. Just because, look at Netflix. The straddle worked out fantastic. Net, it was about 60% overall on the straddle. In between the puts going to almost 0, and the calls going to, and it was a 2-to-1 long bias, right? Twice the money towards the long side, 1 time towards the short side. The puts went to almost 0, and the calls were up about anywhere from 100 to 150%. Net, you're up 60 to 65% for the trade. You had to sell right in the morning. Some people have asked me, so do you hold on? Well, it all depends. I normally don't hold on. I get a nice burp. I take it out first thing. Then I reevaluate and I get in there. Because remember, it's not just this market. It's always been like that. They are going to, first of all, if you get a 150% move on something, what do? You just sit around and twiddle your thumbs? No, you take it out and then you move the strikes up or whatever you need to do, or just say, okay, you're done for the day. And that's the way to go. It's the way I look at it. I am a professional trader. My book is not in the billions. Just kidding. Unless I win the lottery. Even then, my wife would never let me trade with $1 billion. But at the same time, I try to spread my risk. Traders can do what they want. People with day trading accounts can trade stocks. You don't have to trade my options. You can trade the stocks for 3, 4, 5 points. If you have a day trading account, you get 4 times more buying power. A $25,000, which is the SEC limit for the threshold for the day trading account, gives you $100,000 in buying power depending on the cash. It's 4 times the buying power on cash. You guys know that. So if somebody has, let's say, 30,000 in cash or 25,000 all in cash at the end of the day, then they have $100,000 in buying power the next day. You can just trade stocks. You don't even trade the options. And scalp and make yourself a couple of $100, 1,000, 2,000, 3,000, 4,000, 5,000, whatever. We have bigger members in our group who would never come into the chat room because they're busy running their own businesses. And they're cleaning out a couple of $1,000s a day. And they don't trade every day. And they're trading stocks off my alerts. Reversals, they make the most money. Market opens down 300. Futures are up only down 5 right now. They're really moving fast. It's all because of China vowing for a speedier rollout of policies to help the flailing market. I just read that off the Bloomberg on top of one of my screens. So there's different ways to skin a cat. All right, so we know about what's going on. We have the midterm elections coming up in November. That's going to be a big volatile time. You know that. Democrats win, markets are going to fall, then they're going to rise. Why? Because the markets don't give a shit. Under Democratic administrations, the markets have gone up huge. Under Republican administrations, the markets have gone up huge. Markets don't care. Markets care about earnings. They care about growth. They care about interest rates. Interest rates so far have stabilized. At approximately 10-year bond has stabilized at approximately 3.198 or 3.2%. If we have another acceleration move on the TNX, which is the 10-year bond, then obviously we're going to get another a rate tantrum and the market's falling. Do I think the markets are going to move up to 4%? I have no freaking idea. All I know is I look at my charts. Do I think this is going to derail the U.S. economy? No. Has the housing market begun to slump a little bit because of higher mortgage rates? Yes. That is a risk. Housing market is a big pillar of the U.S. economy. We all know that. But inflated housing prices and affordability index have been going down because I live in one of the most expensive, New Jersey, and New York, one of the most expensive housing markets in the country. And the prices went nuts a year ago. Now, the high-end homes, which are north of $1 million, are all starting to pull back. The mid-range homes, which are in the $400,000 to $600,000, that's mid-range in Jersey, are actually still going higher. But the ones which are in the million-plus range, million, 4 million, 5 million, 3 million, they're all coming down. 800,000, 900,000, they're all coming down. That's called rebalancing, supply and demand, right? So that is a risk that I consider to be, on a macroeconomic standpoint, a big risk. And look what the home builders are doing. Look what all these. I don't have that direct in front of me, but I believe Home Depot and Lowe's were taking a real dump, right? So you got to keep that in mind. Will that completely derail the U.S. economy? No, I don't think so. And but can it? Yes. Will the Fed and the Federal Reserve and the U.S. And the invisible hand of the U.S. government allow that to happen? No. They won't. It's too much of it's a national. I used to say that years ago, and I was right. It's a national security threat. Just the way terrorists are national security threat, so is our economy and our housing market. If the housing market starts to really take a tumble, trust me, the Fed is going to cut rates. That's one of the reasons why they're raising rates right now. So they have room to cut rates. Everyone understands that, I hope, right? They're giving themselves room to cut rates if we fall into a quick, fast housing recession. All right? So when they scream and shout at Jerome Powell, and again, I'm not in the favor of raising rates. I just want the markets to go higher and higher, right? He's doing that so he has room to cut rates. I don't know why these stupid things come up. All right. In the meantime, on that note, take a breather for about 15 seconds. As a tactical trader, I don't care. Why? Because I'm not running a mutual fund. I'm not running a $1 billion hedge fund. I was on the institutional fund management business, advising back on my Wall Street days, waking up at 5 in the morning. I still do. Putting on my fancy suit, going out there, meeting clients, getting a couple of $100 million, for them to invest in a year with us, stuff like that. I'm just a trader. I'm just I trade based on my charts. It's a beautiful business. I don't handle other people's money. It's my own money. I have great people like you in my group. So that's the way you got to think. You can always have a macro picture. Yes, the market's going down to hell in the handbasket and stuff. Okay, great. How is that going to make you real money now? Unless you make a major bet towards the fact that 6 months from now we'll be down 10,000 points. And the Dow will be down to 15,000. Fine, you can do that. You can certainly do that. But as a trader, and I'm talking about myself, I run the business as a business. I got to pay my bills, just like you guys. So that brings us to charts. Any quick questions on some of the things I've mentioned right now? Yes, no? Okay. Let me give you one quick positive, which is extremely important for us to keep in mind, which you guys already know. Starting November, the big stock buybacks, the corporate buybacks are starting. Right now, they're in their quiet period. What does that mean? It means during earnings seasons, companies, U.S. corporations, which really what makes America great, are not able to buy back their stock. The stock buyback programs are on a slight sabbatical. They are going to go into full effect in November. What do you think that does to the market? Takes it higher. The amount of stock available for people and individual institutions to buy in the U.S. stock markets is shrinking. Okay? Because the number of shares you can buy, it's kind of a financial engineering kind of manipulated thing to buy are shrinking. So the stock buyback started in November. Net, that's a big positive for the market. It's a support for the market. Now, if you were a corporate finance manager, the CFO of a major public corporation, do you want your stock to be higher? And I do want an answer for this, or lower when you initiate your stock buyback programs?
Lower.
You want a favorable price.
That's not a good answer. You want it lower. What's a favorable price? I want to go buy a Porsche, which is one of the cars I certainly want to buy, GT3 RS, which is $350,000. I want it lower. Lower. That is a favorable price. You see, Mike, you know why I love you? You should be an ultimate politician, because the way you answer the question is what a politician. I want a favorable price. A favorable price for a stock trader means you're paying the least amount for that price. Does everyone understand that? And thank you for the answers. Yes. So, don't they want the markets lower, going, possibly like at a very favorable, cheaper price, going right before they start initiating their stock buyback programs? Yes or no? Yes or no? All right, no one wants to answer. Okay. Yes. All right. So, can the market stay in between volatility moves back and forth? I'm talking about a sustained move. But in between intraday volatility, gap opening up, 16 points, we sell it, we buy it a little bit, we trade individual stocks, but a sustained move on the market towards higher levels, not all-time highs, but higher levels, will not start till November. In between, we can trade. Short, long, long, short. Does everyone understand that important point? Because when the
Yes.
stock buybacks start, it is going to be a sustained move on certain companies, especially the ones with solid earnings. And believe me, I've been doing this for a while, and I see what my members do. On a sustained move in the market, where you get big time, day after day, their gap opening, boom, boom, boom. The individual investors in general do not make much money. Why? Because first, they're not positioned right, and second, they keep that little voice in their head, which is not a technical voice, but an emotional voice, says, oh, it's too high, it's too high. In the meantime, gaps open, higher. So this type of sustained move, because this is a pattern symmetry in progress. This is not a bear market. That I'm going to stand by. A bear market is not starting till 2020. A real bear market. Corrective? Absolutely. I'm not here to change anyone's mind, like I said earlier on. You all have your free. This is the U.S. Constitution is staring at me in front of me. The Declaration of Independence. You have a right to think what you want. I have a right to say what I want. So the sustained move is not going to start till November, which is just a few days away. In between, it's going to be this. This is exactly what is happening here. There. These are the 3 points that you guys all need to focus on. 1, 2, 3, 4, 5, 6. And we're going to do a day count right now, because a long time ago, one of the seminars I attended on trading, and I wasn't a trader, I was a trader on my own. I was on the research side, analytical side, sales side. As a nerd. I'm still a nerd. But the point is that, and they said, always do the day counts. This gentleman said. So very interesting. This is where we are in right now. I'm showing you the bigger picture. You handle it the way it is. I'll put in my trades. I'm not looking for the moon. I'm looking for one price that the market will go to over the short term, which is right here. E-minis at 28.25. It's going to go there. In between, well, can it take a detour to 27.25, slip and retest the downtrend line? Sure, but it's going to go there. If I'm wrong, I'm wrong. Doesn't matter. But this is where it's going to go. This is exact pattern symmetry. March to April, April to the end of April, June, now. In between, we do what we need to do. These are the pattern symmetries of what is going on right now. Not this. Not this. Okay? So let's move on. So where we are, each of these candles. Right now, futures traders, if they were looking at my charts, look at these lines that I drew. Let me just zoom in. And we do have futures traders in our group. Remember, we have anywhere from about 110 to 150, sometimes around 200 on a peak season members. Love to grow it a lot more, but trying to get the word out. And many of them are invisible traders, right? They have their own businesses. Some of them are futures traders. They're using my charts to do what they need to do. They're trading off my charts. This line is a consolidation channel, just the way I drew it. I'm not saying it's perfect, but that's, the lines matched. I'm a pattern guy. I look at it. Hold on for 1 second, guys. And look what it's doing. It's just bouncing off that. So if they were just trading off my charts right now, 27.49. This was as good as it can get to this consolidation channel right there. Then they would be up 27.49, and futures are right now at 27.63. How many points is that? That's 14 points. There'd be 14 handles. 14 handles on this candle alone based off these charts. So we do the same thing on an intraday basis. 14 handles they'd be up. Instead of doing this webinar, I should be doing some futures trading right now, if you ask me. So you guys are costing me money. I'm half kidding, but it's true. A lot of you guys on your brokerage accounts are entitled to futures trading. You should do it sometime. So what you can see here as I amplify this is this period. This is the period. And those are the main ones. Well, there's one more before that. So you can see that right there is 14 points. So during the day, for people who are trading the SPY and the SPX, they can do the same thing. Second point that I want to show in the bigger picture. The amount of days, we're going to do a day count very soon. All right? As a number of days, like, you know, the market vacillates around before it takes off a bit. Is the amount of days a market stays below the 50 and the 34 and the 20-day moving average generally does not exceed 12 to 14 days. There is always a mean reversion. Now, hardcore bears will say, no, this time it's different. I say no. Why? Because since 1996, 1997, when I started to really look at the markets and I got my first job on Wall Street before I moved down from Putnam Investments in Boston, I always said one thing, which I told my clients too. Every crisis is the same for different reasons. The crisis playbook is always the same over the short term. All right? So that's it. You cannot stay below, you cannot not have a mean reversion for a simple reason. The shorts have to take their money off the table. They can't be just looking just the way longs out on a sustained move are looking at their P&Ls, not taking their profits, going higher, it's going higher, it's going higher. The shorts have to, at some point, have to cash that money, right? And that short covering so-called dead cat bounce, if we are truly in a bear market, means there is a mean reversion. By the way, this is the start of, this is 2018. 2018 started on the 2nd of January, 2018. So the bottom line is that, and this is the same thing with stocks. This is the period we're looking at. And here. So the standard deviation from here to here is, at this point, probably a -5. I would say it's a -5. This was the standard deviation from the 34. The red line is the 50. The orange line is the 34-day moving average, which I primarily use. This was like a -7. This was like a -6. This one is, no, this is a -6 or 7. Extreme oversold. So forget all the bigger picture, all the analysis, what China is doing and whether Trump's going to uphold the market, which I know he will. He has to. This is a major deviation, standard deviation. It's way off the highways. Now, the highways have buckled. If you listen to my old videos, you remember one thing. I said when these highways, they buckled here too, by the way. When the 34, this is that orange line, crosses below the 50-day moving average, it's a sign of a weak, intermediate term, downward sloping market. We know that. Nothing new about that. It happened here. When was the last time that crossed down below that? That was back on the 5th of March. And it's happening now. So net, what does that mean? Can somebody tell me? What does it mean for traders? You guys are traders, so I need to, know that and give you the right answer. Dale, good to see you. Can somebody tell me what that means? When you have that crossover, it is a general intermediate term downtrend for reasons I've explained, the China trade wars, the US dollar being too strong, interest rates basically slipping higher, nervousness about so many things, corporate earnings, big companies are going to basically say, hey, listen, you keep on doing this trade war stuff, if China, and the news came out tonight that, whatever, that Trump wants to really put in the pressure for China, so that it doesn't look like a short-term resolution coming up. So what does that mean from a trading perspective? If no one wants to answer, I'm going to call out names. Dale. Okay, people don't want to answer my question. Mike, what does that mean? Dale's driving. Okay, I understand. Okay, go ahead. What do you think? Yeah.
I'm sorry, I wasn't paying attention when you asked the question.
So I'm going to rephrase the question. When you see the 34 and the 50-day moving average crossing below like this, right? That's obviously a negative. That's a negative for the markets over from a broader perspective. So what does that mean from a trading perspective? If you're in a trade, what does that generally mean?
Well, if the faster moving average is crossing above, that's an opportunity to get long. If the faster is moving below,
that's an opportunity to basically short. Okay, right. You're half correct, but I know I'll give you the answer in a second. Razia, what do you think? Because you're good at these short-term trades. Razia?
No answer.
Oh, I'm sorry, what was that, sir?
No answer, just watching.
Okay, no problem. Serge, what do you think it means? Okay. Sarm, what do you think?
Yeah, once the market hits those averages, chances are it'll reverse.
Okay, here's the answer. It's a simple answer. Sell the rallies. Sell. That's exactly what we've been doing with these big gap opens that we get. Sell rallies. That's what it means, guys, okay? Because right now, the market is on an intermediate term downtrend. Yes, we get great opportunities to move up towards 28, 25 and all that stuff and make some decent money. But that doesn't change the trend. The trend right now is down. The trend goes higher. Remember, okay, go back to it. Sell rallies. Sell the pops. Is everyone clear on that? Sell the pops. So if we get up to even 28.71 or somewhere, because remember, it's a moving average, so it recalibrates itself every day, right? So this is coming down. So if it even gets up there, is it time to get excited? Sure, it's excited because we're positioned down at these levels. But you will need to be quick to sell the profits till the lines cross up again. This is the same old story over and over again. Now remember, the lines start to cross up. Remember, these lines broke on the 5th of March. And then on the 19th of March, the lines were still crossing down. This is very important. Yet, the trend was higher in between volatility. The lines kept on going down. There was a double dip. The lines kept on going down. The markets rallied like a monster. But the moving averages, which is 34 and 50 days, the ones I use, okay, which have worked for me for years, still kept on going down. Look, they still kept on going down. Yet, the markets rallied like a monster. You're talking 600, 700, 800% type of options profits. Yet the moving averages kept on going down. They did not cross over towards this was the positive crossover. This was the negative crossover. This is the negative crossover about to happen. So you got 700-800%, if not 1,000% on certain individual stocks, options, short-term options and stuff like that. Yet the crossover did not happen till here. And then you got another leg of the move. Then you got another correction, but the crossover kept on going higher. That means this was a buy. So what I'm getting at in simple terms is that right now, once we get towards these levels, whether it be 2790, 2800, max move 2825, which I've said many times, which will affect every stock that we're trading overall. Of course, certain individual selective stocks don't give a hoot about the market. They do what they need to do. Then you need to sell the pops. So keep that in the back of your head. Now, if some of you think, which I know some of you do think that we're just going to go on a one-way slide down and not have a technical, like Serge mentioned, which is a common way of looking at a dead cat technical reset bounce towards slightly higher levels, then you're wrong. Why are you wrong? Because that's what the market history has shown you you're wrong. Markets don't go down like this with the standard deviation. Markets normally at a standard deviation of 6 to 7 on a technical basis. Always have a bounce. Can it slip and slide a little bit more? Sure. If you expect the market to go down another 1,000 points right away, it has to be another major calamity. Sure, it can happen. But even at the worst times, the standard deviation from the moving averages was roughly around 6 to -7. We are, after all, a technical service. This was -4 from the moving average, distance travel. This is like a -7 at the bottom and roughly about a -6 to where we are right now. So play the bounces, sell the pops. That's all. Now, I said this in the last video, I'll say it again. Trading off the 200-day moving average can be a very profitable venture. Here's your 200-day moving average right now at 27.68. The markets right now went to 27.49 tonight. And right now it's going to try to kiss the 27.69 level again. Now what's interesting is, from purely, like somebody says, okay, what do you think is going to happen this week? I don't know, but I can show you the charts. What is this yellow line here? This is the 5-day moving average that I use from a trader's perspective for quick short-term trades. It's like watching the 5-minute chart, right? So the 5-day moving averages, despite all this crazy structured volatility, is this moving higher or lower? Well, it's going higher. So through all this crazy volatility, the 5-day moving average kept on moving higher till we got big 1, 2, 3, 1,000 point type of rallies. The 5-day moving average is still moving higher. Can we get one of these rallies where I took most of my monthly money out? Which most of you were not even there. You guys know that. Whether you like to admit it or not. It made my month. From a trader's perspective, did I know this was coming? No. Did I place myself around here? Yes. And then it hit that 28.20 level. So at this point, the 28.24, 28.24 E-minis, which is roughly around 28.30 or 28.28 on the S&P, is major resistance. But these rallies, if you think they're going to wave a green flag and say, oh yeah, I'm going to rally 600 points the next day. No, it doesn't work like that. Because the day before, it looked like this. And every single member, well, most members, some in the chat room and stuff, their comments were like, okay, there we go, it's the worst. Okay. I'm just a stupid guy who makes money and loses money. Makes more money than I lose. That's why I'm still here. So that's it. All right, that's your longer term picture. All right. Right now, we're in a broader downtrend. Sell the rallies, trade the ranges. And that's, I don't need to keep on repeating myself, but the ranges are these. So these charts can be used very effectively between the resets and all that crap, technical stuff that happens. Keep in mind, which I mentioned before, I'll say it again. They will not let the market go to hell in a handbasket before the November elections. It is too vital for the national security elections that are coming. It's called the midterm election, just in case you guys didn't know what was coming up. This is still, technically speaking, a large cup and handle. This is still a 1 hour chart that you can trade. A bull will say, hey, this is good. This was the big impulse breakout level back on the 15th or 16th when very few traders were prepared. We were. Boom. Big money. So they'll say, hey, this is starting to look like a W pattern. The bearish guy, because it's cognitive bias, it's how you look at life and trading, will say, no, we're going to 2,700. I say, you know what? That possibility is still there. And if it goes to 2,700, you will have created a very, very large W formation. And you can trade it. This is a trader's market. It has always been a trader's market, but now, because of this enhanced volatility and earnings season, it is a bigger trader's market. That's it. Next. Same chart. A bull will say, hey, that's a beautiful. Well, it's not beautiful. It's a very volatile. I don't like volatility. I don't think any of you guys do. Okay? So, but we make money in volatility. This is still a cup, which can be a handle up to 28.25. What happens in this zone? We don't know. We know this zone can come, and we're prepared for it. So short intraday if you want. Short whatever you want. This is doable. This is doable. This move down here, which means it's 27.12 to 27.61 is roughly 50 points, which means this is a 300-point Dow drop. You can short that. Once it breaks below this handle, you can attempt to short it. People who shorted down here got burned. If it falls again down to 27.43, the emotional mind will say, oh, that's it, it's all over. Well, they can do this again, right? It did that here, or they can slip it down. So each of these levels that I've marked, use them to your own benefit to do what you need to do. I'm not here to change anyone's mind, because I don't know exactly whether it's going to be a W pattern or whether or not. This stochastics is telling me, which allows me to do some very terrific intraday trades, is that we're oversold. We need to get overbought. If it gets overbought, the next level of major resistance, which will happen, will be 27.85. So if we move from where we are right now, 27.62 to 27.85, because that's exactly what it's been doing. How many points on the Dow is that, guys? If we move from 27.62 where we are right now to 27.85, that's roughly 20 points, 23 points. How many points on the Dow is that? Dow Jones Industrial Average. You should have that just on the back of your head. Anyone? Okay, I'm not going to waste time getting answers. This is roughly 100 to a 125 point move on the Dow, which we get within the first 3 hours of the day since we are in this consolidation channel. So what do you do here? You buy more. You buy if it breaks out of it. You sell right away. And it's very clean to see. That's the reason why I produced these charts for you guys to figure out. Just understand a little bit of it. This is it. Will it be definite that it falls back here? No, but most of the times it does. Next. is your daily chart. The daily chart right now is telling me on the futures that we are going to create a double bottom. Okay? This was a massive move higher. The body of the candle was contained, is still contained, believe it or not. These last couple of days after the big move on Tuesday, it is still contained within the body of this. And let me just zoom in. And this is pure technical candle dynamics. Say it for what it's worth. The body of these three, this looked fantastic till this big sell-off came on Thursday, right? This is Thursday, Friday. Friday we're moving up nicely. We sold some nice stuff at the open. Big time. This move from here to here was how much? How much were we up? Like 100 and some points? Sweet. I said sell, sell, sell. Go look at my Twitter feed. And then we had an inverted hammer. In my opinion, that was one of the, I'm not saying it's the last day, but it could have been the last day of the global margin calls that are coming out of China and Europe, in my opinion, because it was a Friday. You know, I worked on Wall Street for a long time, and I saw the margin clerks do not want to carry margin calls over the weekend. Too much risk, because they're liable for that risk. So if you get institutional margin calls, let's say $5 million, $10 million that they have to put in to meet the margin requirements, which is generally around 30%, right? On extreme case, they want to sell out to cover that margin call because the money hasn't been wired in. Does everyone understand that? Okay, no one wants to answer. Okay, great. So bottom line is that even though we had a big up day in China on Thursday, we still had after having a nice up opening, we had a down day on Friday. My opinion, my experience tells me that was institutional margin calls settling the books because they didn't want to carry that margin call over into a Monday because of weekend risk. So at this point, if we look at the candle dynamics, the body of these candles are still within the body of this large, big impulse rally that we had, that 99.9999% of retail emotional traders and institutional traders, I'm sure, but I concentrate on the RET trader because after all, we are the retail traders, were not positioned in, missed out. So if technically speaking, it's still positive candle formation. Stochastics are still kind of mixed. Even though it's a slight positive divergence, it looks like it might want to go do a double bottom, which would be, again, as Rajya pointed out, we're looking for a solid double bottom. That's the solid double bottom you want to look at on the daily. Will it get there? Don't know. It could do this, or it could do this, which would be fantastic. Which means we would be slipping and sliding a little bit more, possibly test the 27 level, the big hammer reversal. So we had two positives on this candle stuff. So focus a little bit, okay? Is we got this big hammer reversal. We got this massive, we got two big hammer reversals, two good ones. And then we got this massive bullish engulfing candle. So we had three positives, one, two, and two negatives. So net, it is still one positive from a candle dynamic standpoint. Is everyone clear on that? Can you guys bear with me for 1 second? I go check something at my door. You guys there? Okay. So the bottom line is this is where we are right now. And let me move on from this chart. I got a couple of quick things to show you guys. This is your daily S&P chart. Just looking at it face value, it still looks like it wants to do a double bottom. That means we're going to come back and retest possibly 2743. You're talking about another 100, 150 points, which is this is the gap fill. If we slip below that, we're going back and testing 2700. We don't know yet, but that's where we are. So the E-mini charts, just so you know, are actually are more constructive. The futures chart, more constructive from a candlestick standpoint than the actual S&P 500 chart, which is not real time. Everyone understand that part? Test, test. Anyone there? Hello? Okay. Okay. I just didn't know if we were connected or not. Okay. Thanks, Milan. So that's where we are. Weekly charts are right here. If I look at the weekly charts with a microscopic, like Razia said, you know, it's like short-term trading is like looking through a microscope. And I mentioned that, you know, looking through a binocular, and I agreed with him. Binocular or a telescope is like really swing trading, where the big money's really made. He's right. When I look at it through a just a regular eye, forget the binoculars and the microscope, this still doesn't look like to me it's bottom. It's looking like it's trying to bottom. So it's slipping and sliding a little bit lower towards 2700 or 2690, where the markets are down another 100 to 200 points, is very likely. Very likely. Even though it ended green, doesn't mean anything. It's still an inverted hammer, it looks like. However, it is following this on the weekly. And what was that? That was March. Remember, each one of these is a week. This was March 26th, April 2nd, 1, 2, 3, 4, 5, 6. 6 weeks it did this. 6 weeks it did this. And we traded it. Absolutely correctly, every single trade? No. Overall, absolutely. Back and forth, back and forth, back and forth. 1, 2, 3, boom, 4, 5, 6. Hammer reversals we bought, sold. So if that's the case, then if this is 1, this was 1, 2, 3, 4, 5, 6, 7 before we started a sustained rally. So if that's the case, if this is 1, we got 2, 3, 4, 5, 6, 7. What does 7 weeks bring to us? December, correct? Takes us through November and brings us into early December, where you get that big rally. Will next 2019 January be like this? Yeah, most probably it will be, according to the wave count. So we got 6 more weeks of big volatility we can make money on. And after that, if there's a sustained uptrend, we'll be fine. We'll see. I can't project that forward yet because a lot of variables are in play. But here we have the big drop. That's number 1. This is number 1. 2, 3, 4, 5, 6, 7. Now, if some of you are waiting for that perfect moment where you just want to put money and just say it'll happen forever, well, it doesn't work like that. So 1, 2, 3 candle. This is weekly count reading. 1, 2, 3, 4, 5, 6. Lots of money to be made in between each of these. These are 2, 3, 400 point moves. 1, 2, 3, 4, 5, 6, 7. Little consolidation. 8, 9. So if that's the case, then this is the first week. 2, 3, 4, 5. Could be like this. 6, 7. It does not. The sustained rally doesn't begin till the first part of December. But in the meantime, this is what we look at. It was an uptrend. In the meantime, it's an uptrend towards 2800 in the higher 2800s. Can you not make money off that? It's, you know, the patterns are so similar, it's not even funny. Now, can it be different? Of course. But if we always looked at things as different, then we would never understand pattern symmetry and we would never do crap. Volatility still went higher. Volatility goes higher. It's going to be, in my opinion, given where we are right now on the weekly overall market charts, this will start to climb back higher. And it did not peak till 7 weeks up the road. Here, you trade. You're going to freak out because you're going to have 50, 100, 200 points down, back and forth. But the general trend remained higher. Now, this was still a bear flag, which never broke down here. Will it be the same this time? We shall see. I don't know yet. If we get into real full-scale trade war with China, we're in the early stages of the trade war. Well, believe me, it will be a bull flag. And we are going to 2,500 on the S&P 500. In other words, we'll be down another 2,000 points. We'll be down to 23,000 on the Dow. And you think my good friend Donald is going to sit around and watch that? No. But we don't know that yet. Am I clear on this one? Yes, no? Can somebody respond?
Yes, it's clear.
Okay, good, man. Appreciate you mentioned that. Okay, so that's it. Now VIX. Let's take a good look at the VIX. VIX doesn't want to give up, which correlates with what I'm saying. We're gonna get choppiness. This is a mixed picture, actually. Why is it a mixed picture? Because if this was a stock chart, remember, you got to read the VIX chart as a stock chart, except the VIX is a derivative product. It's a financial engineering product. To the degree my 19-year-old son is in college for in New York, right? So hopefully he doesn't design the next VIX. So bottom line is he can't stand trading. He's like a math guy, like, his dad doing it all the time. So what son wants to go, I want to just follow dad's footsteps now. Just the way I never became a doctor like my parents were, right? I'd probably be showing charts to a patient and they would probably go, doc, just give me the medicine and just let me, take me out of this pain. Stop showing me your charts. So I said, okay, better not be a doctor. All right. So bottom line is that this, if you look at the internals, it is still a downward sloping internal. No question about it. It is still a massive, massive inverted hammer. But it's still green. That means it can still slip higher towards 24. That's the way I read it. That means the market is still open to be down 150 to 200 points this week, early part of this week, in my opinion. Here's a quick thing of rule of thumb that I noticed over the years. The earlier the markets are down, the first part of the week, the bigger the reflex bounce towards the latter part of the week is stronger. So as a trader, as you have cash on the side and some long positions, you want to be taking advantage of the early week declines and then, boom, sell it on the reflex bounce. Remember what I said earlier. We're on an intermediate term downtrend. Sell the rallies. Just the way we did with Netflix and other stocks. PayPal sold out. Did you see me pushing PayPal on Friday? No. It's a big friggin' move. 200% plus on those few calls in the basket. And a little bit of common. From $2 to $7. Can't beat that. $2,000 to 7,000. 200 to 700. I had one trader I don't want to mention. He put in frigging close to 15 grand. He made so much money on that. It's not even funny. There's always people like that. So that's it. So the VIX is not done yet from what it looks like. Short term, the upper Bollinger is still at 24. It looks like it wants to go there. Or VIX, like I said, is derivative product, so it can be slammed down. This could be the downtrend line. It could be slammed down to 1683. That means the market rallies about 200 points, 100 to 50 or 200 points that I showed, which brings us up to those resistance levels that I showed on the S&P and the E-mini charts. So there's no way to really read it like this. This is a daily chart. The shorter term charts that I show on those colorful charts on the VIX are the ones to really look at. And that is the algo HFT charts on the VIX. You know, the ones with the candles, the black background. Those are the ones that you need to look at. Let me just grab you one so you guys can see it. I think I posted one. There. Got it. There. That's the one you want to monitor during the day. I was having problems with my capture program that I use, so I was taking it with my iPhone and uploading it for you guys. That's the reason it looks like that. Okay, I was just having some sort of Java issue with my screen capture on one of my computers. So look at that. So the VIX is very clear. This is 1702, 1702. That's your support. Here's your. This was actually pivot. And no, it wasn't the pivot, was it? Yeah, I think it was. And right there was a small candle. That small candle was early in the afternoon. So, 1 second. Let me try to make it bigger. Okay. Fast stochastics starting to curl up. That means there's a little bit of, selling came into the market. VIX created a small candle. This chart is so mixed, I can't really, like I said, it could go down here, or it fills the gap again. The nervousness of the market tells me that at one point or another, it will fill the gap again within the next 24 to 48 hours. What does that mean in simple English? It means the market might pop. If it pops, you sell. And then you can always look. I always look at the VIX as a proxy to what's going to happen in the front end. So this chart of the VIX, which is a 1 hour chart, is a great tool. And you guys can use that on your platform. There's your gap. And this is 23. This is the 23 that we are looking at right here, right there, 23. See, I have a line drawn. Now, why do I have that line drawn? I have the line drawn because if I go back on 23 on the VIX, it brings me to this peak. That's why I draw these lines, like where the VIX, supply, demand, the buying and selling came in. So let's forget that long spike. Let's zoom in here. Look at 23, right there. What date was that? 6th of April, 2018. Right there. After that, they slammed the VIX. They slammed the VIX. So we are actually in this zone here. This is pure pattern recognition. We are right here in this zone. Can everyone see the similarity? I need a yes or no answer, please. Can everyone see the similarity? I'm enhancing it. This was on the 5th of April till the 9th of April. Can everyone see the similarity of what happened here to what is happening here? Does everyone see it? Yes? No?
Yep.
Okay, so if you're a pure technician and devoid of any emotion, which I'm certainly not, I have certain emotions, obviously, then it's telling you that if this is the pattern, then the VIX is going to collapse down towards the rising mid-Bollinger, which is around 16, and possibly go to the lower end, which is the breakout level, which is 15. Remember, the VIX is really on a trading range between 15 and 20 and 25. Round numbers, went to almost 30. So bottom line is, if that happens, then the market gets up towards the S&P, like I showed you. It's all correlated. It's all mathematical. It's all algorithmic. And it's all going to affect your stocks on the front end. Most of our stocks we trade, especially the Boeings and stuff of the world, which are directly correlated with the S&P and the Dow Jones Industrial Average. The S&P, if the VIX collapses back towards this level, just the way it did here back in April, then the S&P will hit that 2850 plus level, which is a very decent profit to be made. Short term, the VIX can easily rise up to about 20, back towards the upper Bollinger, which is 25. That means the market will be down anywhere from from 150 to 200 points. The sooner it happens on the earlier part of the week, the better for bullish leaning traders. So I watch the VIX very carefully. Couple of quick charts to show before we end tonight. Just sweep it in for you guys. This is your New York stock McLaren oscillator, which every single webinar that I did, and I showed it at extreme levels, the next day the market went up 400 points. It's a fact. Look at my last webinar. Look what happened to the market the day after. Okay? This is basically right now overbought. Right there. You see that? What does that mean? The market will fall or be a little bit weaker for the first part of Monday. And it is looking like it got overbought. The full stochastics got overbought. Okay? You can see that right there. See that? When we were buying the market at the McLaren oscillator, and I was like not emotional, passionate. And I said, man, you cannot short the market down minus 97. The next day, the market went up 600 frigging points. Up. That was the McLaren oscillator. Then it eased back a little bit. It still wants to go higher, even though it's overbought. So a little back and fill. It closed the day on Friday at minus 32. It might fall back towards minus 50. In fact, the S2 or support 2 is minus 67. We get a nice thud in the market, it can be down to minus 67. Do you want to really short it at minus 67? No. You want to buy it. You want to short the move down here, depending on what happens on the front end of the market. Here is the mixed picture. Does anyone see the MACD? What is happening? The MACD went positive, and the crossover is intact. That is a danger for a dogmatic short, not a tactical short. Some people might not understand the English part of what a difference between a dogmatic and a tactical short is. Dogmatic doesn't mean dogs. It means somebody who is just fanatical, like a fundamentalist, terrorist, okay? Just says, no, it just has to go down. Well, they normally die in the markets overall. So we're not dogmatic, we're tactical, meaning show us the chart, let's try to analyze it, we'll be a tactical short or a long. That's the difference between a dogmatic, strictly fundamentalist, and I hate fundamentalists, from all creeds, colors, and religions, okay? I don't like fundamentalist people because they're just too rigid. So bottom line is that this is showing us this is actually positive. This means short-term overbought. This is okay. That's your McLaren oscillator right now. Still has room to go higher before it gets really overbought. But it's basically a trader's market. Next chart I'm going to show you is not a very accurate chart, but something I look at once in a while during extreme market conditions is the fear and greed index that CNN compliance business compiles. It's extreme fear 14. No, I don't think so. It's extreme fear here. Okay? It's really much lower than 14. Generally speaking, when you get to these levels, boom, you get a move higher. Everybody, traders, mom and pop, almost $6 trillion, last number that I saw, or 5.8 million, trillion in cash on the sidelines. That includes retail investors, institutional investors. Look at the M1, M2 on the Federal Reserve Board, if some of you are real economic freaks, and you'll see how much cash is lying in the M1, M2 cash balances. Everybody is shit scared. All right? What does cash go? Just goes and sleeps in the cash money market? No. They always go back in the asset classes. The stock market, real estate market, bond market. Lots of money going into the bond market. Fear is supreme. Nobody is optimistic. Nobody. Which is normally a sign of a tradable bottom, behaviorally speaking. This is a serious number when I saw that. Second thing I want to show you guys, third thing, whatever, is this, which is the 533 chart. Take it for what it's worth. We swept up nicely. The stochastic crossover is still intact despite this little pullback. This is going back to March, February of this year when the crash happened. And generally speaking, It is, I hate these ads. Generally speaking, when the Stowe crossover is, this was the time to really buy to make the big money, which I'll take full credit for it. I did. I told you guys to do it too. Didn't think it was going to be a 500-600 point rally, but it did. But now, little ease back. Let's see if it does this or whether it just pulls back a little bit, just like the McLaren oscillator, and then moves higher. Here is the positive part, and this is something. This is money in your pocket from a swing standpoint. Take it for what it's worth because it's been right. When the stochastics start to the MACD candles start to basically go from -20, and you can see the bars getting smaller and smaller. They have a 70 to 80% probability, if not 90% probability, because after all, trading is a game of probabilities. It goes positive for a bit. Just the way it happened back in February. And like I said, none of you made the big money in February, March, and May. None of you. Some of you maybe did. I doubt it. Even though we were screaming and shouting, saying, you gotta buy these numbers. So, saying all that, the MACD going like this, getting smaller and smaller, is a good sign. Because once it gets positive, you want to be seller. Unless we have a sustained sustained move where it gets this big again. So I'm not even going that far. I'm simply saying it is getting smaller and smaller. That means that it looks like the market wants to go higher on a technical basis for now. Not the all-time highs, not that crazy stuff, just higher from a trading standpoint. Last chart that I'm going to show you is basically the percentage, or the bullish percentage index. Huge amounts of stocks are below the 50-day moving average, which is, the bear will say it's really bad. The bull will say time for a quick reflex bounce. This was Donald Trump's election. Right here. Look at it very carefully. Right here. November of 2016. This is where we are right now. At 42, we have a bullish percentage index, which was 52 right before the elections. Because everybody was so frigging negative. And we are at -42 right now with the economy humming, with Trump economic policies really bolstering the U.S. markets. And we have bullish percentage index because of interest rates, because of the China trade tariff wars, and the sentiment, which is so deeply bearish. No question about it. At 42. Unbelievable. These were the last two corrections, February and March. These were the bounces, which were huge. This was the big wave 5 bounce that lasted in January, which was huge. And I said that was like not good. Go back, listen to my videos. This was the February crash, and we are resembling the February crash. So what happened after the February crash? We bounced. We fell, retested, we bounced. So we are going to have a bounce. They're going to retest, maybe. And then we'll see what happens. But these are extreme readings. When I look at extreme readings, I just got to smile. Any quick questions? I'm wrapping up, guys. Any quick questions? Anyone? Please. Okay. Final note is earnings. Got lots of opportunities. It's going to be a lot of heartaches. We're trying to minimize the heartaches and bring in the joy. How about that? Let's do it. All right? We're all in the same boat. We mean it. I mean it, obviously. You guys do what you need to do. Post your trades. Put the specifics in there so other people can look at it. Put it in the trading room. Put it in the public chat room. I'm truly happy that you guys attended tonight. It's great for me to do these sessions. Why? Because it makes me think and use my brain so I can explain to other people what I'm looking at. Normally, I'm just a lazy bum. I just want to do things my way and stop explaining to people. But I am, after all, running a service. It's coming straight from the horse's mouth. And take it or leave it. Just use my, some of my information for your own benefit. Here is the last thing I just noticed. This is the RSI on the bullish percentage index, the BPNYA, right? The New York Stock Exchange are giving a lot more credence to New York Stock Exchange stocks because those are the real, solid companies. Look at this. Look at this. Look at this. How deeply in the red we are. It's supposed to be red. Now, unless something's really broken in the global system and everything's going to hell in a handbasket, we're falling into a 2007, 2008, 2008 because the market bottomed on March 9, 2009 type of bear market, you inevitably will get a very sharp bounce. Like I said, sell the pops, short term to intermediate term, one step at a time. This is extreme, guys. Okay, this was extreme February, March. This was the big sell-off before the November 2016 elections that everyone's just going to die because Trump might be president. All kinds of garbage, and this is where we are right now. In the meantime, we have select stocks, play some earnings. Just keep an eye on the charts, do what you need to do, and I'll try to do my best to help you guys. On that note, have a blessed evening, and God bless you all. See you guys tomorrow. Thank you for attending.